Passive Pockets is presented by Equity Trust. Today, we're diving into the 18-year real estate cycle and what it means for investors heading into 2025. From easing interest rates to looming debt maturities, the cycle gives us clues about where the market is headed and which sectors are poised to thrive. But are cycles still relevant today, given the Fed's aggressive interventions and the potential policy shifts on the horizon? Let's find out. Hello, passive investors. Welcome to Passive Pockets, the passive real estate investing show brought to you by Equity Trust. I'm your host, Paul Shannon, and today we're joined by Logan Freeman, an expert in real estate investing, to unpack everything about the real estate cycle and what 2025 holds for investors. Let's jump in. Logan, welcome to the show. How are you today?
Man, it's cold, it's snowy, and it's a winter wonderland here in Kansas City right now, but I couldn't be any more fired up and heated up for our discussion today.
Awesome. Well, I've been excited to have you on. We've been connected for a few years now. You're very well spoken, very informative on LinkedIn, always delivering great insights on the market. Today, I specifically want to drill into something that I think you have intimate knowledge on, and that's real estate cycles, specifically the 18-year real estate cycle. Can you talk to us a little bit about what that is and some of the key phases of the real estate cycle?
Yeah, of course. Real estate has a long history of operating within cycles. It's shaped by fundamental forces of supply, demand, and speculative behavior, right? Among these cycles, the 18.6-year real estate cycle, I think, stands out as one of the most reliable and predictable frameworks for understanding how these property markets, ebb and flow. It's not perfect, right? It's not a science. And I saw this put the other day really well. It's an art and a science. But this specific cycle and kind of mental model has been popularized by economists like Fred Harrison and more recently, Akhil Patel and Phil Anderson, right? And this framework traces its roots to the foundational economic principle, which is the Ricardo's law of economic rent, which we can talk about here in a second. But by understanding both, I think, the mechanics of real estate cycle and the theory of economic rent, we can gain sort of a powerful lens and for interpreting, market trends and anticipating some of those outcomes. So, really quickly, what is Ricardo's law of economic rent? Because this is something that this whole cycle is based upon. And this was, developed by the economist David Ricardo in the early 19th century, right? It just explains how the value of land is derived from its scarcity and productive potential rather than the effort or capital put into it. So in essence, economic rent is the income earned by land or other natural resources, based on its location and its desirability, rather than maybe the active improvement by the owner. So it's tied directly to land scarcity. As land is obviously a finite resource, unlike labor or manufactured goods, which can be expanded. So for example, prime real estate in a central business district generates significantly higher rent than a property on the outskirts of a city simply because of its location and access to resources, infrastructure, and population, right? Okay, so why the heck does this matter? Well, land value appreciation drives the cycle. So land being limited becomes a focal point of the speculative investment during periods of economic growth. So that drives up prices during expansions and creates oversupply or misallocation of resources during contractions. Okay. So then we have speculation and mispricing, right? So Ricardo's insights can reveal how speculative behavior often detach land value from productive uses, leading to bubbles and eventual corrections. Okay. And the last component of this really is economic inequality, and land value appreciation benefits landowners disproportionately, widening the wealth gaps, which, Ray Dalio has been talking about in his Changing World Orders book for quite some time.
I want to understand something and have our listeners understand too. Are we talking about, when you say land value, scarcity, and location, does that mean that real estate cycles are happening at different times all over the country in different cities? They could be in different phases of expansion and contraction? Or are we talking about one broad economic cycle that is more national or even global?
Yeah, that's a great question. And in this context, what has been studied for the 18.6 year real estate cycle really is the United States economic land and cycle. So that would be at a national level, not a global level, because what's going on in other countries can be highly different than what we have going on here in the United States. But what I would say, obviously being real estate and real estate investors, everyone understands that what's going on in my market is different than what's going on in somebody else's market. But generally speaking, some of these macroeconomic trends, such as credit, liquidity, and land prices, are going to have a general theme across those submarkets. Okay. So that's kind of the context that I would think about this in, but definitely not a global perspective here.
Makes sense. Talk to us a little bit about the cycle from start to finish and the different phases that are involved during that period and how you can kind of predict maybe where we are, given historical context. We'll talk about the last cycle in a few minutes, but just give us a framework for what to think about here as far as the cycle from start to finish.
So Ricardo's principles underpin the mechanics of the 18.6 year real estate cycle. And this cycle repeats over nearly 2 decades. We've talked about this, but driven by land scarcity, speculative behavior, and the credit markets. And it consists of 5 key phases. So this first expansion phase is 7 years. And so here's what typically happens. We have a recovery from a downturn or a crisis, and that fuels economic growth and investment, right? And so right now, what would happen in this phase is land and property values are going to rise steadily as confidence returns to the market. Right. And so just connecting this back to the law of economic rent here would be the productive potential of undervalued land is realized, right? Which drives increased demand for development. Okay. Then we move on to what's called the mid-cycle slowdown. This is typically 2 to 3 years. And what happens here is external factors such as maybe trade tensions or what we saw recently in pandemics that temporarily slows growth. So development and land transactions or real estate transactions pause, creating kind of a cooling off period. Right. And connecting this back to the law of economic rent, land values usually remain stable as the speculative activity pauses, but underlying scarcity continues to hold value. And so then we move into our second expansion phase. All right. This is 4 to 5 years up, right? Okay. So in this phase, we have rapid economic growth, which is going to continue to resume. And that's fueled by kind of the speculative investment and increased credit availability is what we typically see here. So what happens? Well, land value rises rapidly and development accelerates, often leading to potential oversupply. And I am hinting, yes, at where we are, potentially here in some markets in the United States right now. But this is where speculation drives land values, and that it's typically beyond their productive use, which creates inefficiencies. And we get into a really interesting phase of the cycle, which is kind of called the winner's curse. And this is when asset prices are peaking, and this is driven by frenzy and optimism, and that famous term of "this time is different," right? And so we typically see a lot of oversupply and rising interest rates begin to reveal vulnerabilities. So landowners are demanding unsustainable rents, further detaching land values from productive capacity. Okay, so after we hit the winner's curse, then we come into where no one really likes to be at, which is the contraction phase. And this is when a market correction happens or a recession reduces land values and transaction volumes. Okay, and underperforming assets face a lot of financial stress here. Speculative excesses are flushed out, and the repricing of land brings values back in line with productive potential, creating opportunities for the strategic investor. So just thinking about this 18.6 year real estate cycle, it's typically 7 years up, a mid-cycle slowdown, another 5 to 6 years up, winner's curse, and then we have our contraction phase. So that's kind of the overarching theme of this. Now, I want to be very open and honest about this. This does not happen on an exact date, on an exact year either. Given the last 250 years of this has been kind of studied, there have been a few periods of times where this hasn't happened, right? Which is mostly around the world wars. But also, thinking about this, it typically is 18 years, give or take 2 years. Okay. So it's not going to be 18.6 right on the dot, right? That's just a really catchy marketing phrase. And so when people hear that, they say, oh my gosh, this guy is saying this is going to happen at 18.6 years. No, give or take 2 years on either side, depending on what's going on. So I just want to make sure I give a little bit of context and further clarification there.
I definitely want to get into where we are today, right? Because that's most relevant. And we're, a group of passive investors that are interested in how this might be applied to our investing strategy moving forward. But let's talk about in historical context. We could touch on a lot of different market cycles, but the one that has completed in recent history was the one that ran from 1993 till about 2010. Can you talk to us about some of the key events that happened? Every cycle is different, but they, just like Mark Twain says, history doesn't repeat itself, but it often rhymes. What did that cycle look like, and what did we learn from that cycle, if anything?
Thinking about this back in 1993, I would have been 3 years old at this time. So, one thing I've learned from Ray Dalio is a lot of people think that this hasn't happened before just because they haven't experienced it, right? And that is a blind spot as investors that we have to be very aware of. And he gives really great examples in all of his books about how he learned that lesson the hard way. But thinking about the first expansion phase going from 1993 to 2000, you also have to think this is the post-savings and loans crisis recovery, which began around 1993. All right. So there was an economic boom of the 1990s, which was fueled by low inflation, technological advancements, and robust commercial development. Okay. Fast forward to 2001, we see a mid-cycle slowdown. What happened? Well, the dot-com burst, the bubble burst, and then that was followed by the 9/11 attacks. So we had recessionary pressures impacted commercial real estate at that time, leading to a temporary slowdown in development and in leasing activity. All right. After that, we had our second expansion phase. So this would be from 2003 to 2007. And this is where we had massive economic growth that was fueled by cheap credit, high leverage, and speculative real estate investment. So commercial real estate prices surged due to the easy financing and the optimistic investor behavior, right? And so then we think about, okay, well, what happened in 2007? Well, that's when the winner's curse was going on with speculative overpricing and record transaction volumes. Well, we all know what happened in 2008 to 2010. The great financial crisis led to a severe contraction in commercial real estate and just real estate in general. We had widespread defaults. We had collapsing property values and frozen capital markets define that phase. When you think about it in that context, that's very eerily, similar to kind of the model of the 18.6 year real estate cycle. Now, you take a look at this and you think about 1993 to 2010, right? I mean, that's about 17, 18 years, right? So again, not 18.6 years on the dot, but give or take a year or two on either side. And you can kind of see these themes happening out in these cycles.
That's fascinating. If you think about Great Financial Crisis, 2007, 2008, 2009. You've got the 2001 tech stock bubble. A lot of people consider those like two separate events, as if they were two market tops or two cycles being sort of completed where irrational exuberance takes over. But if you look at it in a broader perspective, it's all part of one commercial real estate cycle. There can be cycles within cycles, and I think a lot of it is driven by human sentiment, right? It's driven by human emotion and just sort of that getting caught up in the frenzy, so to speak. Would you agree?
I would agree. And the other thing that I will say is, economics, and Phil Anderson talks a lot about this in his book, The Secret Life of Banking and Real Estate. But economists typically aren't taking into consideration. So when you are thinking about these business cycles or just cycles in general, maybe the big debt crisis or the debt cycles that Dalio talks about, a lot of them don't take into consideration land. And they do not take in consideration real estate. And I don't know necessarily why. I will not speculate as to why. Let Phil Anderson do that, because he has long curly hair and I don't need to be the Phil Anderson of the world. But go read that and you can start learning about the lunar cycle and all these different things as well, which is super interesting. But I think it's fascinating that land cycles are not really taken into consideration when we think about business cycles and economics just in general, right? And so I think that's a big component that, if you're in business, you don't know anything about real estate. Real estate has nothing to do with you. Or if you're in real estate, you're not really thinking about what's going on with businesses and how much CapEx they're spending and how that's impacting that. But the two are intimately intertwined and they do work off of each other. And so I think that's a context that us as real estate investors should be thinking about in further detail, as well as researching, because when you bring those two together, you really start to see some repeatable patterns and why things are happening.
In the context of the 18.6 year cycle, where do you think we currently stand? You mentioned, quote unquote, the winner's curse. What evidence do you have which suggests that that's where we're about in the cycle today?
According to this 18.6 year real estate cycle, I do think that we are in this winner curse phase, which is, having us enter into some early stages of a contraction at some period of time. The way that I think about this is tracking transaction volumes and the amounts of different transactions, because transaction volumes have to be broken down from sales and leasing. And I have just so much data in my, market, because that's what I serve in Kansas City, but understanding the difference between, okay, there might have been $3 billion worth of real estate done in Kansas City this year, but how much of that was leases versus investment sales? And I'll tell you, the differences between 2022 and 2023 are drastic. But, I think that understanding that right now, land values and property values, we have seen a surge due to scarcity and speculative activity in hot markets, especially in areas like industrial and multifamily sectors. Now, you may be saying, yeah, but aren't prices coming down? Well, year over year, from 2023 to 2024, prices were up 5%. Yes, the previous 2 years, we were pretty well flatlined, maybe a 1 to 2% kind of increase. Now, we have to remove office out of this out as an outlier, because many of the headlines that we're seeing, especially around troubled loans and different, fire sales, are in that office sector. But I just interviewed a gentleman who all his job is to understand data in Kansas City and St. Louis markets. We are seeing a big surge back into the leasing activity of office. So I'm hoping that could have been a little bit of a blip. But, when you take the workforce and say, hey, you don't need to work in an office environment anymore, that's obviously going to have a pretty big impact on that asset class, right? And it's going to have some pain. However, I think that right now, if you talk to any developer around the country, I've talked to a lot of them here recently, they're facing higher costs with, some oversupply in some of these areas, from a multifamily standpoint. We've definitely seen that in some markets. But, I think that investors are trying to begin to recalibrate their expectations, focusing on productive potential and sustainable returns. But if you take the winner's curse and say that we're going to expand in 2025 and 2026, okay, well, think about transaction volumes and where we have been here previously. If I can, I would love to just kind of give you a quick rundown. In 2020, well, let me actually back up even a little bit further, okay? 2007, commercial real estate transaction volumes nationally peaked at $571 billion. And that was driven by easy access to credit and rapid asset appreciation. I bring 2007 up because that was the last winner's curse that we have been going through. Okay. Fast forward to 2009, the transaction volumes plummeted to $52 billion as financial crises froze the credit markets and investor confidence collapsed. Okay. We fast forward to 2021. This is the post-COVID recovery. Transactions volumes reached a record $900 billion. And we all know that was fueled by low interest rates, government stimulus, and a lot of pent-up demand. Well, so what's happened in 2023 and 2024? And what's the outlook for 2025? Well, in 23 and 24, volumes fell dramatically, hitting approximately around $300 billion in 2024. And why? Well, that was due to the Federal Reserve's aggressive rate hikes and tightened lending conditions. Okay. And so 2025's forecast, a lot of different experts are now predicting that transaction volumes are going to climb to around $400 to $450 billion this year in 2025, which marks a much needed rebound for many of us real estate investors. While that's still below the record highs of 2021, I don't know when we get back to $900 billion nationally, it does represent a significant recovery from the recent lows. So you can go from 2020 at 435 billion, 2021, 2022, somewhere between 800 and 900 billion. And then we moved to 2023, 2024, 350 to 400 billion. And going into this year, hopefully we can rebound to 400 and 450 billion dollars. Well, that would say if experts are predicting that transaction volumes are coming up, well, why? Well, we have some sort of clarity in regards to at least where interest rates may or may not be telegraphed that they're being risen, right? So if I'm underwriting a deal, I can at least may have some more confidence than I did, a couple of years ago that, it's not going to be 100 or 150 basis points higher whenever I close this transaction. That freezes transaction volumes. Okay. And so I think that's number one. Number two is debt maturities are going to create urgency. We have approximately $600 billion in commercial real estate loans that are set to mature in 2025. And another 1.2 trillion due by 2026. That debt needs to be refinanced, restructured, or sold, right? And many of these are going to be non-discretionary sellers, creating some sort of urgency in the market. Okay, if that's the case, right? And we go back to our methodology and our framework of the 18.6 year real estate cycle. If the credit right now is a little more liquid, I'm talking to banks on a regular basis. I'm talking to investors. They're finding debt. It may not be at the interest rate that they want, but at least banks are lending, right? We have seen CMBS lending increase substantially. We are seeing lending opening back up. Okay, so that's going to create this liquidity, which allows for transaction volumes to rebound. Well, what happens at the end of 2025 and 2026 when all of this debt comes to mature and somebody had a 4% interest rate, now they have to refinance at a 7.5% interest rate? Well, guess what? That might line up really well with a huge contraction phase, which would line up exactly in line with this 18.6 year real estate cycle of maybe a year or two, maybe even 3 of a correction phase that allows us to kind of wipe out some of this bad debt. And we get back to transaction volumes as well as, pricing that makes sense for investors to step back into the marketplace. You and I both know when that happens, the government's going to do everything that they possibly can to make things happen. Well, where's the interest rates right now? They're high, right? I don't know where they're at. 475, 500 basis points. I don't know what the federal funds rate is. 450 to 500, right? Something around there. Okay. Well, they now have a tool, right? And they have a tool to try to maybe get out of this correction phase. So I do foresee that potentially being a tool that they utilize that could bring us back out of this correction at some point. And I guarantee you they will try to make sure that we don't have this big correction, but I just don't see where we're at with so many other different factors that the government and or the powers that be can really make a huge dent in this real estate cycle where we're at currently. I feel like the can has been kicked down the road for quite some time. I know that debt is maturing. Banks are going to need to do something with that. We have discretionary and non-discretionary sellers. And I think it's lining up to be a really interesting 2025 going into 2026. I forecast that transaction volumes will be up 10 to 15% on both of those years, as well as pricing continuing to rise. And I think that after that, I have no real outlook as to when this contraction actually happens, because, there's going to be the powers that be are going to do everything that they can to keep us from falling so they get reelected. And that's not just because of the current administration. That's just because of what politicians do. And so that's where I think we are currently. And that's a little bit of context on maybe why I think that it's lining up to be pretty similar framework to what we have seen in 1993 to 2010.
Very interesting and insightful historical perspective lining up with today. And if the math is correct, then it would appear that 2028, 29 could be rocky roads. And ironically, that kind of lines up with when a new presidential administration would come in again. It's obvious that interest rates play a key role in this monetary policy as far as the cycle. If there's cheap cost of capital, people get excited, a lot of deals happen. If things, interest rates rise, it becomes a little bit more difficult for people to operate with thinner margins, and a lot of the players drop out and property values fall. How do you think policy risk plays into this? Like, there's some uncertainties today about tariffs and immigration and such. How do you think those factors play in, if at all, to this real estate cycle?
Business cycles, stock market is more like a roller coaster. It's up, it's down, because we can sell just like this. Commercial real estate is more like the Ferris wheel. right? It takes more time for these ripple effects to really take hold. But your question around policy and tariffs and immigration really comes down to inflation. And it comes down to inflation because inflation's not in real estate. It's not just about rising prices at the grocery store. I mean, somebody go buy some milk and eggs right now. It's unbelievable, right? But it's about how much more investors are willing to pay for land and for buildings, often due to that cheap credit and that speculative behavior. Howard Marks, in his book, Mastering the Market Cycles, talks all about how much influence the investor psychology actually has on the markets. In his business, you're able to see these things happen in much more real time than we are in real estate. So, it will take 60 to 90 days for us to really understand what pricing is for that last quarter, right? And because these deals take time, right? And so I think that one thing that you can kind of think about and see here, and this is in his book, Phil Anderson's book, but this is kind of what he calls the skyscraper indicator, right? And so when you start to see monumental projects or record-breaking buildings, that's often a sign of speculative overconfidence. And historically, these projects are completed during or just after a downturn, as they take years to plan and execute. The Empire State Building, for example, when it was delivered in a terrible time. It was called the empty Empire State Building for a long time because it just didn't get leased up. So back to your question, I think that all of those things have a really crucial role in the real estate cycle. However, inflation, capital flows, so that's one thing that I would say could be even more impactful than interest rates is there actually liquidity in the market? Because if you're a real estate operator and your debt is coming due and they're like, hey, we're not going to extend this loan. You either need to pay this off or you need to sell it. You don't want to sell because you can't sell, but you could go get another loan. Do you think you care if the loan is 400 basis points higher than what you previously had? It might be better than losing the real estate deal, right? And being completely wiped out. But if you're in a period of time where there is no liquidity, you don't have that option. Right. So that's my point being around, potentially capital flows being more impactful on cap rates than maybe interest rates are at that period of time. So I think that, for investors in this period of time, we have to take into consideration affordability, policy and tariff impacts. But what I have noticed is that real estate is hyper local, and so are the policies that are impacting that real estate. So yes, your federal government is going to have some impact on your real estate. For example, let's think about opportunity zones and just how beneficial or non-beneficial, depending on your perspective, opportunity zones were. I know in my market in Kansas City, opportunity zones were absolutely unbelievable for certain periods of time. And we attracted Samara Road from New York City to do a $500 million to $1 billion development in the West Bottoms, which was just a derelict place where nobody lived. And now you go down there and there's cranes and there's people living there and there's artists down there, and it's becoming more of a safe area to live. My sister lives down there now because of what has happened with opportunity zones. So I think that they do have an impact, yes, but it's on a hyper local standpoint. Tariffs definitely get me a little bit concerned, right? Because when I was thinking about tariffs in wood, in concrete, and steel, the main building components to commercial real estate, we already have an affordability challenge in this country. And so, if that continues, one of two things happens. The developers have to pass that cost on to the consumer, which is even more unaffordable, or development just stops. Well, I would say that over the last 2 years, construction starts have been really low, right? We've had a lot of deliveries coming in line, which may actually save some of these oversupplied markets if they can ride this out. However, starts are coming back, and they're coming back in very unique ways. We have over 6,500 units being developed in Kansas City today on the multifamily side. 82% of those projects have some sort of public-private partnership to be able to get those deals done. And so I was listening to Ivy Zellman and Willie Walker talk the other day, and there was a couple things that they really thought that you could do to help create more affordable and or attainable housing. Number one, reduce impact fees. right? And that's not a federal government thing. That is a local municipality thing. Yes, it may need to start at the state, but you can move that down to those other submarkets in those municipalities. Impact fees in California are 15% of the overall project cost. That's unbelievable. I'm sorry, California, but that's really unbelievable. That makes it very hard for a developer to do anything in that state. And so I think that's one thing they can absolutely do. And on the federal government side, the other piece that they may be able to do is, unless, the Freddie Mac and Fannie Mae become privatized, or what they're talking about is, expand the underwriting criteria. And it might not just be from a credit standpoint or liquidity standpoint, but what types of products are they willing to lend on, right? We saw a big stand, a year or two ago when they stepped into the mobile home space. I thought that was really great, right? They started to lend in that space, and that had an impactful policy that was great for that space. So I think that those things do have an impact, but I think they are smaller in the regards to the overall and or larger economic cycle that, they may have a little bit of delay, or they can serve a certain market. But when we think about the overarching framework, there are so many things that have tailwinds pushing us to the point where we're at right now, which I don't see really many of those levers being able to be, ripped out outside of, this is the number one thing, major technological boom and productivity, right? And that is the one thing. We can grow our way out of challenges, but we can't probably save our way out of these challenges. So if we grow our way out of these challenges, which in the real estate side is very difficult to do right now on a national level for developing product, but if we can, from a technological standpoint, grow our way out of this through productivity and potentially a very successful sovereign wealth fund in the United States, investing in those technologies and hopefully investing in technologies like fully volumetric modular construction, micro units. That was a trend that happened 2 or 3 years ago. It had zero impact on the market, but fully volumetric modular construction really could impact the market if we can figure out a way to create affordable and attainable housing through that, because it addresses two things. One, it addresses time to market, but two, it addresses the labor shortage that we've all seen in the trades.
Fantastic. Tons of information there, a lot to digest. I think what our group is probably most interested to hear is your crystal ball projections. We know you don't have one, but if you were to predict, we've got, 5 years or so potentially left in this cycle. LPs are looking for places to place their capital that's safe. Preservation of principal is top of mind with what's happened over the last couple of years. Where do you feel like there's some outperformance maybe in certain sectors, or how would you advise the Passive Pockets community to look at the next 5 years and kind of prepare their portfolio?
There's so many more things I would like to talk about, especially around Ray Dalio's big debt cycle, as well as Neil Howe's book, The Fourth Turning, and just more even debt and debt devaluation and inflation. However, I would say this, here's a good playbook. I think this is my playbook, right? For 2025 to 2030. So right now, being late in the cycle, I am working on harvesting gains from land speculation. And I am also working on refinancing into fixed rate long-term debt. Thankfully, I didn't take any variable rate debt, but I'm advising people, if you can, try to see if you can refinance into some fixed rate longer term debt, right? So the other thing that I am doing, I'm strengthening the cash flows from existing properties. So really focus, since we're not doing a ton of acquisitions, really focusing on getting those modified gross leases on our commercial portfolio switched over to triple net leases, right? Maintaining liquidity for future buying opportunities. The other thing that I think is a really interesting play right now is something that I have heard recently coined land squatting. So going in, getting land tied up and getting it through the entitlement process and selling that back into a more liquid or a late cycle where you have shorter term, duration. It's not going to cash flow for you, but if you can get a deal knowing that builders and developers are looking for a product type, if you can get that land developed and sell that paper to them, that's a really interesting strategy. But right now, really trying to focus on maintaining liquidity for future buying opportunities. So we fast forward to maybe 2027 to 2030, right? The correction phase. Well, I think this is a period of time where you can acquire, distressed land and real estate assets. And I like to focus on essential sectors during this period of time. So attainable affordable housing, industrial, logistics, those types of assets have done really well, I think, in times of contraction periods. Things that maybe didn't were more trendy real estate, right? Experiential retail, or maybe even, I don't know a ton about this asset class, but, are people going to continue to go to RV parks and things like that when their cash flow is a little bit lower? I don't necessarily know, but less of the trendy things, more on the essential sectors. And, partnering with, I think, capital rich institutions that are seeking, experienced operators, right? And so here's one thing that I think is interesting for real estate investors right now. The investors that have gone through let's call it 2019 to 2025 now have been through some sort of real estate cycle, right? And lots of them are no longer there talking about real estate, right? I mean, people have been wiped out. We've seen the stories, and I don't need to go into that necessarily. However, the folks that, you talked to in 2019 and 2020, the guys and gals that were just getting started and they've made it through, and they've maybe sold some assets or they've taken some things full cycle, might be a really good opportunity to go back and see who you were talking with in 2019 and 2020 and revisit those conversations, right? I think that's a playbook that I am doing, and just saying, oh my gosh, that was 5-6 years ago now, and we should reconnect and see what you've got going on. So my final thought, just on this is that cycles are going to collide. The 18.6 year real estate cycle, the fourth turning crisis, Dalio's debt cycle reset, they're all converging, I believe, in the second half of this decade. And so I don't think this is a time for complacency. I think this is a time for vigilancy, for being liquid, being informed. And I think that if the more that you can understand about previous and historical cycles, you can turn this next crisis into some generational wealth opportunities, and there's a quote that I always like to go back to, but fortunes are made in downturns, right? Not when things are easy. So be ready. And I think that is, where my head is right now, just in speaking with many different real estate investors, developers, and folks in the marketplace. But it's easy right now to get caught up in, I've been pent up for 2 years and it's now time to get, my next opportunity. I'm not saying don't do that, right? But I am saying that you should really be, and I was talking about this yesterday, really be stress testing these real estate deals. And I mean, really stress testing them. And my favorite way to do this is really thinking about IRR partitioning. How much return is actually coming from the sale versus how much is coming from the cash flows that are here right now and or rent roll upside that has already been proven, right? Because your guess, Paul, is as good as mine, as good as Jay Parsons about where rents are actually going to go. We have been surprised many times here in the past, but I would say that a lot of those markets seeing 3.5% to 5.5% to 10% year over year rent growth, that may be a little bit in the past. I've seen quite a few reports coming out saying, hey, the renters market is over and we're going to start being able to push rents again. Maybe is kind of the way that I think about that. So yeah, I think that's my playbook for right now going in to the next 3 to 4 years.
Well said, man. This has been an incredibly insightful conversation. I could pick your brain for hours, but we do have to wrap up. If people want to learn more about you and find you, where can they look?
Well, I'm very active on LinkedIn. So Logan Freeman, self-proclaimed Mr. Kansas City there on LinkedIn. I try to take all of these thoughts and put them into a newsletter. No products to sell you or anything like that. Just trying to educate. And frankly, it's a learning process for me. And then if I can take my thoughts and get them out on paper and get a conversation going, I get to learn through that as well.
Well, it's been fantastic, Logan. Thanks again for coming on the show, and we'll talk soon.
Thanks for having me.
That's it for this episode of Passive Pockets, brought to you by Equity Trust. A huge thanks to Logan Freeman for breaking down the 18.6 year real estate cycle and what 2025 holds for real estate investors. If you enjoyed this episode, don't forget to like, subscribe, and share your thoughts or questions in the comments. For more resources on passive investing, visit our website, passivepockets.com, and join our community with a 7-day free trial. Thanks for tuning in, and as always, happy investing.